thank ANZ for sponsoring this session, and I'd like to introduce the panel. Tanya Smith, Director of Sustainable Finance at ANZ. She will be your moderator this afternoon. Adam Roberts, Senior Vice President, Investment Director at Cerberus Capital Management. Christy Graham, Executive Director, Australian Finance Institute. Carl Eisenhower, Head of Sales, Australia and New Zealand, Moody's ESG Solutions, and Rick Walters, Chief of Standards and Innovation at GRESB. Ladies and gentlemen, your panel.
Hi everyone, thank you for joining us today. To those of you who are in the room joining us, but also to everyone, I'm not sure where the cameras are, but online, thanks for joining us virtually. We wanted to start today's panel by acknowledging the traditional owners on the land in which we meet today, which are the Gadigal people of the Eora Nation, hopefully I've said that correctly, and pay our respects to their elders past, present and emerging. As you know, my name is Tanya Smith. I'm a director in the Sustainable Finance team at ANZ and the facilitator for today. We have an incredibly and highly knowledgeable panel to speak to you today, who I will introduce in a little bit more detail shortly, so that you have an idea of the perspective that they bring to this conversation. But firstly, we wanted to do a little bit more scene setting and explain why there is a panel of finance professionals talking at an infrastructure conference. As you know, at ANZ, our purpose is to shape a world where individuals and communities thrive. And in order to deliver that, we sort of think about three key themes. So environmental sustainability, housing, and financial well-being, particularly for our customers and the projects that we're delivering. And just like us, the majority of the global investment community are interested in supporting infrastructure projects that are driving positive, long-term sustainable outcomes. And that's why sustainable finance is so important, because it helps support those outcomes that we're all trying to achieve in our day-to-day jobs. So the sustainable finance sector has now reached a cumulative issuance globally at the end of last year of $4 trillion. So it's a really big emerging theme that's starting to affect each of our roles. And so we wanted to unpack that a little bit more for you today, so that you can understand what it is specifically, how it works, and particularly who's driving it and how it's becoming relevant to you in your day-to-day roles. In preparing for the panel today, we assume that there's probably a variety of different knowledge levels amongst the audience, and so we really wanted to go through some of the basics, and we've actually left quite a lot of time for questions as well. So hopefully most of you have worked out how to use the app now, and we'll be, I've got the iPad here, we're going to leave a reasonable time for questions, and there's no question too silly, no question too small. This panel knows their stuff, so please ask away anything that you like, and we'll make sure that we can get those answers to you on today's panel. Okay, without further ado, I'd like to go into a little bit more detail about the background of each of the panellists, so you know what the unique perspective is that they bring, because we've got a variety of people from across the sector today. So first up, Adam Roberts is a Senior Vice President and Investment Director at Cerberus Capital Management, and he used to be an Investment Director for Macquarie Asset Management as well. So Adam's career has focused a lot on impact investing within the infrastructure and real estate sectors, so he really understands the sorts of projects that you guys are working on day to day. And the knowledge and perspective that he brings today to today's panel is really that of an investor. So if you have questions specifically around that, direct them towards Adam. We next have Christy Graham, who's the Executive Director at the Australian Sustainable Finance Institute, or as it's affectionately known by many of us, ASFI. So Christy works with leaders across the finance sector in Australia to enable more capital to flow to social, environmental and particularly climate impactful projects and companies. And Christy's background spans working in social impact investing, climate finance, natural capital. She's had a really diverse set of experience, and she's bringing a policy perspective today to the conversation, but also sort of a broader macro level perspective of what's happening in the sustainable finance sector. Next, a face that many of you will know very well, Rick Walters, who's the Chief of Standards and Innovation at GRES, and an industry professional in the sector with a career spanning over 30 years across engineering, investment management and standard setting. Rick was instrumental in setting up what was then known as ISCA and is now the IS Council, and he brings the perspective of industry participants as well as global ESG benchmarking and data providers to today's panel, a really core component of the sustainable finance sector. And last but not least, Carl Eisenhower, Head of Moody's ESG Solutions across Australia and New Zealand. So Carl is responsible for a team focused on delivering ESG solutions across climate data, ESG measures, sustainability ratings and second-party opinions, which are core elements of the underpinning the sustainable finance market. Carl has qualifications in environmental management and almost 20 years of experience as a corporate banker, actually. And so he really understands the infrastructure and metals and mining space really well, and has had lots of exposure to traditional banking products and brings that perspective to today's panel. So now that you all understand the different perspectives that they bring, please make sure if you have specific questions, you can address them to the right individual in the questions. And we might get started with the discussion, shall we? So first off today, we wanted the panel to talk about what is sustainable finance and what role does infrastructure play in the sustainable finance market. And I think we have a slide. Yeah, great. So I might pass to Christy first.
Excellent. And thanks for the introduction, Tanya. As Tanya mentioned, ASFI is very much a collaboration of large investors, banks, insurers and financial services firms that are really committed to supporting the growth of sustainable finance and recognising the really critical underpinning role that finance plays in a sustainable, resilient, inclusive Australia as well. So what is sustainable finance is really critical to everything that we do as ASFI. And there's quite a broad definition. So very much any type of financial service. So as I mentioned, that could be banking, that could be insurance, that could be investment, it could be accounting, it could be advisory, that integrates environment, social and governance considerations into the provision of that service or that product to benefit clients, stakeholders and society more broadly. So it has a really broad lens. And the slide that we've got up now shows the broad spectrum of sustainable finance that our colleagues at RIA, the Responsible Investors Association of Australasia, have put together that brings together a number of different frameworks. And I think there's a few things to take from the slide. One is that there's a range of intentions in terms of from avoiding harm right through to contributing to solutions. So there's a really broad range of intentions as to why different types of investors or different financial services firms come to sustainable finance. The other is outcomes as well. There's a range of outcomes. So it goes from a managing risk perspective right through to creating positive impact as well. And there's a range of different methods. So while this framework was established from an investment perspective, the same applies to banking. So or sort of other parts of capital markets. So you can have ESG integration. You can look at screening, both negative or positive. You can go to engagement, either as a shareholder or with your customers if you're in banking. And then to very much intentionally kind of making decisions based not just on risk return, but also the impact of that investment decision or financing decision you're making. So I'll just draw out a few key things and then pass to others to bring that more specifically to the infrastructure space. One is ESG, as I mentioned, environment, social and governance. So a huge range of issues captured under that ESG, and different parts of finance will concentrate on different elements of those ESG issues. So for many it might be climate, possibly on the mitigation side, or it might be natural capital biodiversity as sort of another E issue, or it may be, as we heard in the panel before, kind of modern slavery and supply chain risks under the S. So there's huge variation, and different investors or different parts of the finance sector will think about emphasising different elements of ESG. The other thing to draw out is sustainable finance cuts across different financial services. So, as I mentioned, it's different providers of capital or contributors, so private equity, venture capital, debt markets, banking, and it's a lens that is really in insurance as well. So sustainability needs to be supported by all of these different types of financial services and products right across in the infrastructure space, the life cycle of the project, and others I'm sure will speak in more detail. The final thing I'll draw out is that sustainable finance covers both the risk and opportunity side. So I guess when it started, many people looked at it with a risk lens. There's increasing progression and development and maturity, I would say, in the sustainable finance market to be looking at the positive opportunities arising either from shifts in ESG issues, so transforming to net zero as an economy, or shifts in consumer preferences around some of these ESG issues as well.
Yeah. So, Adam, we've heard a lot about impact in discussions around sustainable finance, and there's also lots of reference to acronyms and frameworks. I'm wondering if you could talk to us about some of those relevant frameworks. We've heard about the SDGs, principles of responsible investment, principles of responsible banking, things like that. As someone who comes at this from an investor's perspective, can you talk to us about some of those relevant frameworks and how they would factor into your thinking around particularly the infrastructure sector?
Yeah, sure. So I think when you sort of look at the spectrum that's up on the screen, I think you'd be very hard pressed to find an investment firm that hadn't at least looked at coming out of the far left-hand side and moving across the spectrum. And that's ultimately driven by investment strategy or where their underlying capital comes from. But everybody's really seen a need that, whether it's a carrot or a stick, that this is something that they need to engage on. I think, when you think about, maybe a decade ago, this was very much looked at through the risk lens. But I think with anything sort of new or nascent, it's quite important to have bodies or groups coming together to try to standardise how they should think about that. And it was great to see the SDGs sitting around the room. These things are all a step in the right direction and helps create a language set that sits around this and sort of a common set of standards to sort of think through when you're sort of thinking about investments. I think because it's a new and nascent sector, people are looking to, bodies to come together. The United Nations has done, very well with its principles of responsible investing and its sustainable development goals. That obviously applies more to, let's say, sort of equity investors as opposed to, maybe debt financiers or insurance companies. And as you sort of see these things sort of evolve and mature, people will then start to take them, I guess, further across the spectrum to be able to be doing, more, which their sort of investor base is sort of demanding of them. And so I think, when you think through sort of the sort of furthest to the left around sort of ESG integration, I think you'll see everybody, nearly everybody is starting to do this now. And if you take the cynical approach, it's because it's good investment. Especially when you think about infrastructure investing, they're very capital intensive projects that need to live for a long time. And whether you're financing with debt or insuring or providing equity to these kind of projects, you need to know that they've got a long, useful life in them, not just in the bricks and mortar that you put in the ground, but in both the sort of social license to operate as well as just the business model that goes with them.
Yeah, cool. Thanks, Adam. Rick, you've in your career looked at, I guess, this sector from both the side as an engineer as well as an investment management perspective. For people in the room who are working on projects, they'll be working on a variety of different project types. Might you be able to talk to some of the differences that might, in those projects that might appeal to different parts of the spectrum?
Yeah, it's a good question, and some of you might be thinking, or maybe they're in the other group, but you might be thinking, why does this matter? And I work on a project, it's a government project. What the investment world think or do matter at all? But we've already talked about some of the different areas where investors, bankers, insurers all get involved, and they're in one way or another involved in every project. Every project needs insurance, for example. So the fingers of the finance world are all over the place in terms of infrastructure. So you can't kind of ignore it, I guess. It might not be visible to you every day working on an infrastructure project. You might think it's a government infrastructure project, what's this got to do? But it's one thing it's important to recognise that. And then the other thing to recognise is that, with infrastructure is there's a big surge and investment in infrastructure. Yes, governments are funding a lot of that, but also, I guess, the role of the private sector is becoming more necessary, more needed. There's all kinds of issues around how do we pay for infrastructure and who pays for what and all that kind of thing. And most Western governments are going towards more private involvement for various reasons. And so what investors think is becoming more and more important. So a lot of projects are going to have investors involved in them, maybe early, maybe later. And having that in mind and understanding that world is very important. You look at big examples in Sydney, like the Greater Western Sydney Airport. They don't have private investment yet, but they probably will, and they are preparing for that. They need to cater for how does that market see them, how they're positioning themselves, what kind of information do they have, how they engage with them, all those kind of things. And invariably, most projects at some point will have that kind of involvement. So you need to be aware of that. You need to understand that world to some degree. How much, depends on where you're at and those sorts of things. And I think, having worked on both, I'm an engineer by background, having worked on both sides of working in the real economy as finance world calls what many of you do, and then in the, I don't know what it is, the other economy, the fake economy, or the finance world, there are completely different angles, and they don't connect in many ways. What engineers call infrastructure is not what investors call infrastructure, which might amaze people. Investors define infrastructure as it's a very stable asset. It's an asset class. What's an asset class? Okay, it's an asset class. It's got certain characteristics. It's got monopolistic characteristics. It's got stable returns. It's got barriers to entry. All these kind of things. What are you talking about? These little finance terms. Aren't we just talking about concrete and steel? So again, there's these different angles that investors and engineers are coming from, and it is very useful to understand both those perspectives. So the other characteristic that investors are looking for with infrastructure, and it's important to understand, is they're looking for low risk, low return. What do you mean they're looking for low return? Why would they want low return? Well, risk and return go together. They want low, stable investments that they can trust. These are long-term investments. And that fits with their clients' business of getting a portfolio. So their clients do want high risk, high return stuff as well. That's not infrastructure. That's private equity, that's other things, that's venture capital, all these other things that they do. So understanding where infrastructure fits in the investor space is important. So a lot of the things we've actually heard in the last 2 days talked about, oh, that's exciting, that's infrastructure, we should do a project on that. That's not what investors call infrastructure. That's amazing stuff that needs to be financed. Don't go looking for an infrastructure investor when you're talking about some new hydrogen project. They're not going to go near it. So, but a private equity investor might be, well, that's super exciting because that could make a 50% return, but it's really high risk because it may fail. So anyway, it's important to understand how that investment world works. When it comes to the spectrum and overlaying infrastructure with the spectrum, where does it fit? There's again lots of debate about how you can look at that. I think invariably like you're saying with investors, every infrastructure project should have ESG integration as well. And I think most of these considerations you can see from this conference are being looked at. When it comes to pushing right at the other end, impact investing, there's certainly an argument to say that all infrastructure investing perhaps is an impact investment. Now, the two criteria which are a little bit tricky to work out with that is intentionality. So if it is an investor going and investing in an infrastructure project because they intend to get a good impact for society, the environment, maybe not. And additionality. So if they hadn't have invested in that project, would that impact have happened anyway? Again, a lot of those things are debatable, and probably at the end of the day, they don't matter very much. What matters is that the impact is created and the project is invested and the project is successful. So hopefully that gives you a bit of some of that joining up of the thinking. But I guess as a more recent entrant to the finance world in the last sort of 5 or so years, it's been interesting to see those comparisons. Hopefully I've shared some of that, and fascinating to see how the two worlds are starting to get way more connected. I think that the final thing I'll finish with on that is that, okay, it might not be happening and apparent on all your projects right now, but I can tell you that, and having worked in Europe for the last few years, the investment world is moving super fast with this. So it may feel with infrastructure like it's so slow and we're hardly getting any change. Watch out, because the investment world is moving super fast with this. They want change. They see the opportunities, as was mentioned, and they're going to drive them one way or another. Infrastructure and the traditional providers of infrastructure has an opportunity to be part of that and have some great success. It's going to happen anyway, though. So you want to be part of it, or somebody else is going to do it anyway. Whether that's a Google or an Amazon or something. These people are gunning for this kind of space. So it's a great opportunity. We should take it up.
Yeah, amazing. Thanks, Rick. And so, Carl, Rick mentioned a number of times infrastructure as an asset class, which not everyone here might understand, but curious to know your perspective coming from Moody's, which is, traditionally a credit rating agency, and moving into more ESG data and information and services. How is the investment community using those services or tapping into this infrastructure asset class to help fund climate mitigation strategies or enhance outcomes in terms of environmental or social?
Yeah, look, I mean, you talked about it before, Tanya, in terms of the finance, the sustainable finance market volume going through the system. It's substantial, and we're forecasting it to grow again this year. And I think, like most people, and I think the infrastructure asset class is uniquely positioned to take advantage of the sustainable finance market, and that's for a few reasons. Rick touched on a few of those. But long dated useful life forces us to think about, okay, what does the future look like on these sorts of projects, and the financing arrangements that go with them also look into the future from that perspective. So ability to repay and the credit profile of the asset or the company that's involved. I think the other thing is just around annuity type revenue streams. Again, sort of gives that confidence and comfort to lenders and investors around investing in this asset class, particularly around sustainable finance. And I think the other thing that infrastructure has the benefit of is all those attributes then ultimately lead to their ability to build financial resilience. And we'll talk a little bit about resilience more broadly as an asset class as well. But I think what's becoming more important is assets and companies being able to have that financial resilience to adapt to physical climate risk, for example. And I think infrastructure is uniquely placed to be able to position for that compared to others, and take advantage of things like the sustainable finance market to do that. And I think in terms of the volume going through historically and going forward, I think because of all those reasons, infrastructure will take a larger share of those markets going forward.
Yeah, that's fabulous. And I think all of you have touched on this appeal to the investment community of infrastructure, and this desire to have impact with their investments. What are driving investors? What led to this shift in their approach? Most people growing up would have known that investment communities were interested in returns and making money and getting rich and the things like that. So what's really driving this change in investor focus? And I'm particularly interested in that in respect to some of the schemes, rating schemes. We've got IS ratings, which most of the people in this room will be familiar with, GRES rating systems, Moody's sort of ESG ratings. What is driving investors, and how do those rating systems sort of fit into that? Maybe, Rick, if you want to give your perspective first. I know you've sort of spent a lot of time in Europe and moved back recently. I know that some of it's coming out of Europe, so maybe if you want to talk about that.
Yeah, Europe's probably leading particularly on the regulatory front. And ASFI's obviously got a heritage from what's happening in Europe in terms of understanding that, responding to that. So a quick background on the European scene, and there's a lot more to unpack. Go on the websites and so on. But But they've got a sustainable finance agenda and roadmap for the European Union, where it's going, a whole bunch of elements to that. But that includes a lot of regulation around defining what sustainable finance is. And that includes a taxonomy, so a classification of what is green. It doesn't dictate what you can and can't invest in, but with, I guess further to your question, with investors moving more and more towards wanting to invest in green things, in sustainable finance, they want to know what that is, and they want to know with confidence, and they want to avoid greenwashing. So this classification that the EU has come up with will play a very strong role, and I guess those who are not falling within the classification are pretty scared, and there's been politics around that. Does gas fit within it, and so on, nuclear. Much as it doesn't say anything about what you can and can't invest in as an investor, people realise that it's going to start to define, a growing section of the market and push other people out. So they better make sure that they're in the classification or something like that. Then there's sort of reporting elements that are being regulated as well. So to go along with classification, there's a whole bunch of reporting through acronyms like SFDR and CSRD and all these things. But anyway, essentially it's just saying you as an investor, you as a fund, you as a company will have to report on a whole bunch of ESG metrics, starting with climate, moving on to adaptation, moving on to other environmental aspects, and moving on to social aspects. So they're defining a set of things that need to be reported on by everybody. So that's kind of sweeping across Europe and being implemented as fast as they can, but certain things hold back at times, and going through the European parliamentary process takes time. But I guess the industry has been, in a way, surprised by how fast it's going and keeping up with that. And it's certainly spreading across the globe too. So those kind of taxonomies, and ASPI being a good example of a response and the thinking here in Australia, everyone's thinking about how to respond, how to define, do we need a classification for Australia? Canada's doing one, everyone else is doing kind of, China's got a memorandum of understanding with Europe working on and there's a global move as well. So there's all these parts moving. It's going to filter around everywhere, it is. And I guess, from an infrastructure perspective, if you look down, say, the EU taxonomy, for example, a whole bunch of things in that are infrastructure. They're either whole projects or they're parts of projects. They're activities within projects. So, and I guess then there's other things coming out like the carbon border adjustment mechanism and other things that are going to impact us because our goods exported to Europe are going to be hit with these kind of impacts. So everything's going to flow in one way or another. And the investors are often global too. So a Macquarie or someone who's the biggest infrastructure investor in the world, okay, they're Australian, but they've got their major office in London and they invest all over the place. They're going to be reporting into the EU as well as what they're doing in Australia and so on. So these investors have to be across all of this, understand this, react to this. And they're looking for standardization as well. They're looking for one way of doing things, perhaps, ideally, in an ideal world. So the various frameworks like GRESB and others are looking to how do we support these efforts and these frameworks. We're, for example, providing an SFDR solution that particularly in Europe will be needed on top of our GRESB assessment. And
do you want to explain what SFDR is?
Briefly, Sustainable Finance Disclosure Regulation. So any provider of funds, products, they call them, in Europe, into investors in Europe, will have to report annually on SFDR and the status of their funds. Again, there's classifications for funds, but they'll have to report a whole bunch of metrics. So everyone's being tied into this, and that's whether they consider themselves green or not, they'll have to report certain things. So, this regulation is kind of sweeping across. How the rest of the world responds is a moving feast, but certainly investors are more and more wanting sort of standardization, harmonization. We can talk more about that perhaps as we go on. I guess this is going to sweep across everywhere, and the investors are going to start bringing it, and ASPI is a good response to that, I think.
Yeah, definitely. Adam, as an investor, both at Macquarie, global firm, and Cerberus as well, are there any of those drivers that you seem to feel more pressure from or relate to on a day-to-day basis? Because there's a lot of different pressure points in encouraging the investment community to focus on this more there some specific ones that you notice in your day-to-day job more than others?
Yeah, I think investors like certainty, or to put it the opposite way, hate uncertainty. And so whether you agree or disagree with any of these things, you just like to know that there is a roadmap that you're working towards when you're making your investment decisions. And so that's why you like to see sort of standardisation or harmonisation across jurisdictions. Capital moves very quickly from one place to another these days, and so I think it's great that Europe has taken the thought leadership piece around that, and it's great to then see that trickle across other jurisdictions as well. But maybe we touched on earlier, how did we get to where we are with this? I think there's sort of three sort of big macro trends. Probably a younger generation and a sort of a social license. I think there's then a world of sort of more wealth and forced savings for retirement, and then probably the third sits around low interest rates as well. So you sort of see there's kind of two big things at play here. One is just on the infrastructure side, and you've got a lot of people wanting to invest in infrastructure because there is some predictability and certainty around the cash flows. In good times or bad times, people need to use what we're thinking of as traditional infrastructure here, and that helps you have some certainty around those investments. And there's more and more capital that's looking to find a home. So just as the tides rise, there's more and more people that are trying to find these projects, and there's only a finite amount of them around the world. So that increases the demand for investing into infrastructure. I think then the second thing that's happened, as interest rates are lower, it's a bit more sort of nerdy finance speak, but there's sort of less return that's being earned from fixed income or sort of lending. And as a result, people are looking for alternatives for that allocation of their portfolio. And so when they look at infrastructure, it has some similar characteristics to lending money or to buying bonds. And so that's then also driving a structural shift in how people are sort of comprising their portfolio. Means that there's more interest in infrastructure as well. And then on the other side, when you look at sort of the sort of social license to operate now, and this is a generational shift where people are more, they're not just focused on shareholder returns, but they're focused on sort of stakeholder outcomes. I think when you look at sort of the average millennial in 5 years will be the CIO of most organisations, just the way that things have changed through, and they are, they're from a different breed now, where they are more prepared to be inclusive around the stakeholders that they are making decisions and investing on behalf of. And that includes the environment as a stakeholder, as well as people or employees, shareholders, etc. And when those things come together, you start to have an increased focus on the sustainability side, and then you also have a lot more capital trying to come into infrastructure. So when you link the two together, you see why there's a lot of interest and a lot of capital trying to find a home in the sector.
Yeah, great. And Christy, from the Australian perspective specifically, is that the same case for all of the Australian sort of circumstances? Are there other drivers, state legislation, things like that people in Australia are focused on?
Yeah, I think Rick made the very good point that in Europe this is very much being driven by government, and in Australia a slightly different situation in that at the state level there's absolutely kind of around climate, the states have really led the charge on net zero commitments, interim targets and sectoral kind of policies to get different sectors to that point. That hasn't happened at the federal level. We now though do have sort of a net zero target. But what was really interesting, I think, in the lead up to COP was to see the huge mobilisation of the finance sector, and the Glasgow Financial Alliance for Net Zero really put $130 trillion on the table to support the transition to net zero. So regardless of sort of government leading the charge, there's really clear signals at both the global level and I think at the Australian level that the finance sector is really stepping up and taking leadership. So in the Australian context, I think ASFI is a really good demonstration of the leadership being taken by the sector. Yeah. So there's a number of the biggest kind of asset managers, asset owners, the biggest banks, insurers, as well as broader financial services firms that have really stood behind ASFI and said, we not only have our organisational commitments to sustainable finance, and that might be new products and services, either responding to risks or seeking some of the opportunities, but we're willing to do the heavy lifting with others in this collaborative way across industry with government and regulators, bringing kind of the whole sector on board to really drive the growth and the impact of finance in Australia. So I think that leadership being shown is kind of being driven from a different part of the Australian economy, but there's sort of very much an open and inclusive way of bringing other parts of the system along as well.
Yeah, amazing. And so for individual projects and the like, we've heard a lot about the importance of impact and how investors are seeking that, and they're being driven by a variety of factors both here and overseas. Carl, coming from Moody's and working in that sort of rating space and working on ESG solutions, how are the investors using products like yours or GRESB or IS ratings to help inform their decisions, and what sort of, how are they making use of those tools, and really how is that translating into the day-to-day of investment?
Yeah, I mean, obviously ratings and frameworks, we've talked about a number of different ones. I think you can get lost in the acronyms and how many there are out there now. I think what's really important is, things like transparency and integrity when we look at these types of transactions from a credit debt perspective. And those, application of those frameworks and external ratings help, provide confidence around those transactions for investors and lenders. I think obviously these things are also a good mitigant to the concept of greenwashing with transactions as well. So it keeps people a little bit honest. When I say people, I'm talking about issuers and banks and others. So I think that's really important as well. And I think it's interesting. Obviously, innovation continues to happen within sustainable finance, and what does that mean more broadly for these frameworks, etc.? I mean, I think we're seeing more and more the envelope being pushed to see how you can get a deal done and take advantage of some of the benefits within these structures. But I think it's players like ourselves that are providing those second-party opinions and providing the ratings help bring things back to what I call the spirit of what these frameworks have been put in place for. So I think the demand for independent verification, for independent ratings, will continue even as the market matures. Given some of those factors around innovation, and look, some investors are more sophisticated than others. So the European investor is a lot more sophisticated around sustainable finance and ESG than perhaps some of their Asian counterparts, for example. So if there's an Asian bond, a Reg S bond that's going to be issued into Asia, tapping the Asian investor universe, they may be more inclined to require some sort of third-party verification on those transactions than perhaps a European investor that's looking at a Euro MTN or some other sort of product. So I think it's the whole importance around the frameworks, the rating systems is critical to supporting the sustainable finance movement and market going forward.
Yeah, cool. Thanks, Carl. You mentioned greenwashing, and we're going to move into some of the questions now because we already have a lot, but if people have additional questions, please send them through now or like or star the other questions. There is one here around greenwashing within sustainable finance, and it's something that's been front of the news on a few different occasions. What is the role of financial institutions in preventing that from occurring? How do investors, banks, and others prevent corporates or individuals from getting involved in greenwashing?
I'm happy to
have a view on that?
Yeah, I have a view on that. Obviously, just with Moody's ESG solutions and the services we provide, we sit across a lot of different transactions in the market, whether with different banks, different issuers, whether it's public bonds, whether it's bank debt. So we see a lot of different things. And look, going back to some of my points before, around that integrity and transparency piece, and then back to my point around frameworks, and trying to stick to, there's been people that have, what do we call them, the standard setters. Okay, there's people a lot smarter than me that have put a lot of these standards in place and thought through a lot of these issues. So it's important to maintain those frameworks and the integrity around them, and so that's sort of where we see our role in the sustainable finance market, and sort of trying to prevent the greenwashing that may occur, particularly as innovation starts to progress through the system. And I'm sure you see that as well, Tanya, in your day-to-day, as a banker in your role as well. So
yes, we get a lot of comments and interest in the risk of greenwashing. Things like IS ratings, GRESB infrastructure ratings, Moody's ESG ratings, they really help to combat that risk of greenwashing because they're credible, well-developed systems and tools that the industry professionals can use. I think also for all of you here today, you guys are working on projects, you know the detailed information about how sustainable your projects are.
Sorry,
I think.
Oh, we lost your mic.
Have a loud voice anyway. Thank you. I think it's really important that all of you in your day-to-day jobs focus on communicating the positive sides of your projects and any risks that may need to be addressed, but communicating those up the chain to the people involved in the commercial decisions, making sure that information on impact and outcomes is getting through to the investors so it can help them make informed decisions.
I think that's a good point, Tanya, around the sustainable finance market has probably to date been more focused at the corporate level as opposed to the specific project level. Now that's changing. I think there's opportunity for that to grow even further. The last few days in Australia, there's been a few announcements about a few transactions that have happened in that space. But yeah, I think there'll be more opportunity for specific project level transactions to occur with that green or sustainable framework in place as the market matures.
Great.
Can I just jump in and add something on that? In terms of greenwashing, this is where taxonomies that Rick mentioned earlier really come to the fore, because it's a common set of definitions at the economic activity level, not sort of at the product or transaction level as well. So really having that commonly agreed understanding of what are the thresholds in terms of emissions intensity, for example, a particular economic activity needs to meet to be classified as sustainable, helps everyone talk about sustainability in a common way and in a way that's interoperable with how, for example, a European entity would also be talking about sustainability. So as Rick kind of alluded to, ASFI is very much taking on the mantle to be considering what an Australian sustainable finance taxonomy looks like and ensuring that it's fit for purpose for the Australian context, but also that there's that international interoperability and credibility given the global nature of capital markets that we've talked about as well.
We've had a few questions. Okay, hopefully that's better. We've had a few questions here around specific products. There's two questions, so I'll ask them one each. Gerard has asked, I've heard recently that to get a sustainability ESG linked loan, you need to set new targets. How do companies who have already ambitious targets qualify for sustainability linked loans? Now maybe, does anyone want to give a bit of background on what a sustainability linked loan is?
I'm happy to
Carl, go first and give a background, and then you can talk about the target setting element.
Yeah, sure. So a sustainability linked loan effectively is a loan where the pricing or the margin on the debt is linked to KPIs linked to ESG or sustainability. So that's a very simplistic way of explaining it. Now, the question then becomes, how do you set the KPIs that help give the issuer or the borrower the ability to benefit from those reductions or penalty, it goes both ways, on the price. So, I think there's obviously been, again, a lot of evolution and a lot of innovation around what some of those metrics or KPIs may be, but again, from a Moody's perspective, we always sort of go back to sort of first principles and fundamentals around things like UN Sustainability Development Goals. How is it all linking back to the spirit of what a lot of these frameworks were put in place for in the first place? So, I don't know, Tanya, you probably have some views on some of those KPIs and things as well.
I do, but we'll give the other analysts an opportunity. Does anyone else have anything they want to say?
I can add to that, I guess. I would disagree with that there has to be new. I certainly know of some sustainability linked loans which are based on KPIs and in some cases GRES ratings, that company, that asset had been getting for many years. And then their KPI was, well, if they can improve their score, their performance, they'll get a lower interest rate. And if they go backwards on their performance, they'll get a higher interest rate. And that, in one particular case, they decided they had some reputational issues that they were tackling, wanted to improve their reputation and undo some damage that had happened. They decided to forego any benefit that they got from an improved interest rate. So yes, they would get a lower interest rate, and then they were donating that to environmental charity. So there's all kinds of ways you can angle this, and depending on what your drivers are and so on. But yeah, my understanding is certainly that there's been plenty that don't have to need a completely new KPI where there's no track record of performance or something like that.
Great. To give others background from the bank market, at least, we follow what's called the sustainability-linked loan principles and the sustainability-linked bond principles for when we're facilitating capital market transactions. Those principles, when they were initially developed, which was only a few years ago, suggested that targets needed to go above and beyond what was publicly stated. They've all been revised in the last year or so, and that emphasis is less strong. What they've stated now is they've clarified that targets need to be considered ambitious, and they define ambition in 3 dimensions. So ambition in comparison to your historic performance on a metric, whether that be emissions, water, waste. Ambitious in terms of how it is compared to your peers. So benchmarking and looking at is something ambitious in the context of the wider market, and also ambitious in the context of science or industry benchmarks. So those are the 3 lenses via which the investment community, and particularly the bank market and debt providers, are thinking about whether or not targets are sufficiently ambitious. So there may be corporate targets that meet those requirements and some corporate targets that don't. I would hazard to guess that a lot of ESG-linked loans or sustainability-linked loans, sustainability coordinators are pushing for corporates and projects to go beyond net zero by 2050 if possible, but obviously using the Paris Agreement and science-based targets to set that as kind of a minimum benchmark. So if your corporate targets are less than that, then it might be hard.
I think the other thing, Tanya, that tends to happen is the advice is, don't go with one metric. There's usually tends to be multiple metrics that are used in these transactions, whether it be bank debt or bonds. And I know that's something we definitely look at when providing those opinions on the transactions.
Great. So we've just been told that there's only 5 minutes left. So I'll have one more question from the iPad, and then I'll give you each an opportunity to sort of have a final statement about maybe emerging themes. Both questions are similar. But I think also, because there have been quite a few questions, I'm happy to commit to putting some dot points down for those afterwards. So we'll share that with the ISC people, and we'll make sure that we get answers to all of you. But there's a question here around, in addition to green bonds and green loans, where the assets are specifically green, and the sustainability-linked loans that we were just talking about before, what are some of the other innovative debt instruments that we're seeing, and what other innovative rating tools can help drive the transition within the infrastructure sector? Does anyone want to speak about other sorts of sustainable finance products that they're seeing?
I can touch on that a little bit. Just given I sit across a variety of different things, I think one is around derivatives. So ESG-linked derivatives is a new space, relatively new, probably 12, 18 months old. So we're seeing some transactions where you might have an existing loan in place that you don't want to touch for whatever reason. And you're trying to structure a derivative overlay which mirrors the ESG-linked nature of a sustainability-linked loan. So getting a little bit technical here, but again, it's one of these examples of innovation that's happening in the market, and people pushing the envelope. The other thing is obviously, carbon offsets is probably to some extent, relevant to sustainable finance. again, that's going to be a continued growing area. That's probably one of the things that we can talk about. But seeing a lot more innovation around that, and also what is deemed a carbon offset instrument. Talking to some of the government regulators, for example, there's a lot of question marks about lots of different things that are happening globally in that space, how they're verified. So it's quite interesting to see some of the innovation that's happening, but don't know what others are seeing in the market.
Others, perspectives?
Maybe on the investment side, green deposits is another thing.
I'm not sure about products, but I guess if you're trying to sort of get into this space and attract capital, with probably main driver around this, it just makes sense to start and keep it simple, I think, and remember that regardless of the way you're investing or what investment you're attracting and the structure or whatever, another key aspect is the engagement. So every investor that invests in something, even if it's a loan, they want to monitor how it's going. They want to engage at least at some level to be sure that their investment, their loan is going to be repaid or whatever it is. And they're interested. And so every one of you that's working on a project where there is an investor, there's somebody. Okay, maybe they're in London or something, or in New York, but there's somebody who actually cares about how, from an ESG perspective, about what you're doing. If you can kind of bridge that gap and connect and swim past your investor relations people and whatever, but make those connections. There's people that are interested, want to engage, want to talk about the real world stuff about what's going on, and want to know what you're doing to improve, what you're doing to get better, how you're managing the risks, all that sort of stuff. So there's a whole world there of opportunity to pursue better. I'll give you one quick example, which hardly ever comes up but should come up all the time, is you all know on your projects, I've had so many conversations just in the last day and a half, that there's some sort of small extra thing you could do that is going to have like a return of like 40%. It's a no-brainer, but it's a whole of life issue, and your project's not going to pay for it, because it's extra cost to the project, and the operator will get it. So, never going to happen. But you could actually go to your already investor and say, I've got a deal for you. It's only going to cost $2 million, and it's got a 40% return. Now, they'll be like, oh my God, okay, maybe 2 million is too small to worry about, but a 40% return, I already know you, so I don't have to do any due diligence. I'm already invested in you. This sounds amazing. Why wouldn't I do that? That's an amazing proposition, but it never happens. So I think getting this engagement and getting this discussion around risks, but also around opportunities, is an amazing opportunity for the infrastructure space. Because I know all you guys, you've got all these ideas in your head. We just need to make them happen.
Great, thanks. Now, because we're running really short of time, and I will get in trouble if we go over, I thought we would finish with the last question. If you could each take 30 seconds or less, ideally, but to identify one or two emerging ESG themes that you think will shape or drive or influence sustainable finance and infrastructure in the next couple of years. So I might start with you, Adam. Are there any themes that you think?
Sure. I think we've touched on the E in ESG a lot today when it's coming from a green or environmental perspective, but I think sort of social infrastructure is sort of the next big wave to come, especially coming out of COVID, when governments have bigger and bigger balance sheets in terms of the debt, and there's sort of more and more increased inequality going around the world. There just needs to be a solution in this space. I think lots of people are working really hard at it, but that's probably the next place that it's probably a few years behind the sort of the green investment that we've seen over the last few years, but it's probably, if you were to look forward to 2025 or 2030, that will be sort of the next big investment area.
Yeah, cool. And I guess people can use some of the SDGs to help communicate that to the investment community.
I think there's lots of things out there now which you've learnt the first time around that will just sort of accelerate the investment this time.
Great. Christy?
I would absolutely agree with Adam, and particularly social and affordable housing, disability housing, those types of social infrastructure. Under the E, I would say natural capital and biodiversity-related risk is probably coming down the pipe even sooner than that.
Great. Rick?
Yeah, I'd probably add to the biodiversity and nature, and we've got the TNFD being worked on, which is the next rung from the TCFD, so nature being the next rung. I'd also say embodied carbon, that's something that's been talked a lot about in this conference, and it's something that's pretty hard for investors to wrap their heads around. It takes much more of a long-term whole-of-life kind of view, but I think it's definitely rising up the agenda, and people are recognising that have to figure out how finance can support changes in embodied carbon. But that's a puzzle that needs a lot of cooperation to unpack.
And Carl?
Yeah. Look, being the finance credit guy, I think, just bringing it back to, financial issues. I talked about it before about financial resilience. And I think one thing that's getting more and more airtime that I'm seeing is around adaptation spend for inbuilt physical climate risk that's already in the system, unfortunately. So particularly from my colleagues in the credit side of things, in the credit rating world, they're very much looking at that more and more around the ability of borrowers and issuers to fund this adaptation cost. And back to my point earlier around sustainable finance is a key way that they can do that.
Yeah, amazing. And for that, I'll add from the debt perspective, I think two of the emerging themes, so carbon markets and how they work particularly in Australia versus Europe, and then I think focus, as Rick mentioned, embodied carbon, broader scope 3 is a big focus for a lot of debt providers. So please, everyone, join me in putting your hands together for the panellists. They've done a really great job. And we'll try and work with the ISC people to get some of the other questions answered and put that up somewhere on their website. Thanks very much. Back over to you, Ron.
And please also thank ANZ who sponsored this particular session as well. So thank you to them.